So we have the most overvalued and dangerous market there has ever been in the existence of mankind. And there's a whole heck of a lot of things, Dunnigan, that have to go right to keep it afloat.
This Cyber Week's specials with Miles Franklin Precious Metal Investments. Silver Philharmonics for only $360 over spot. Backdated Silver Eagles for only $850 over spot. And 100-ounce Royal Canadian Mint silver bars for only $265 over spot per ounce. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We have a returning guest. Michael Pento, the founder of Pento Portfolio Strategies, an active money manager, is here with us again this Monday, November 29, 2021. Michael, thank you for coming back on Liberty and Finance.
Always good to be with you, Dunnigan, and your fast-growing firm.
Yeah, we have a lot of interest, and a lot of our viewers who have subscribed are also referring their friends and family members and coworkers and so on to follow us because they realize that a lot of the insights that our guests provide are not ones that they'll find on mainstream sources or even from their traditional money managers. So we've had, in fact, it's been quite interesting. You as a money manager probably could predict this, that we've even had money managers becoming clients and saying that they wish that their management would allow them to talk to people about other asset classes than just stocks, bonds, ETFs, that kind of thing. And they're not allowed to.
Yeah, it's a revolution underway. So, I mean, I'm independent, RIA, I clear through Charles Schwab. I'm a fiduciary. I can buy anything I want. I can go to 100% cash or almost 0% cash. I can buy gold or I could short gold. And I have indeed bought, as you know, I bought some gold through you, and I was very happy with the service. So you have my complete underwritten recommendation for your clients to go through you. Purchase gold. If they haven't had 5% gold in their portfolio yet, this is a great time to get it because I don't think it's going to be on sale for much longer. And I can explain that. Sure.
Yeah, that's one of the questions that we're going to just get right into this because we have a number of viewers' questions, a whole bunch of them that have been submitted ahead of your arrival. A lot of them are talking about just looking for an update from you on your outlook for the markets in general. Inspector Jason says, do you believe 2022 will prove to be a huge year for gold and silver markets due to the Fed's economic crisis / money printing? And others are asking about your outlook on the equities markets, which you've talked to us about. Steve Ross Holmes asks about your outlook, including have anything changed your outlook, including the new COVID variant, for disinflationary followed by deflationary and eventually high inflationary outlook for 2022. So big picture that you see as your outlook for the markets in the next few quarters?
It's very important. I don't care if you invest with me or not. It's very important to invest with someone who is independent, who doesn't have to sell what their main office is trying to pimp to the rest of the world, what bond they're selling, what equity they're underwriting. So you have to have someone whose only goal as a fiduciary is to make you money wherever that leads. So let's go into where that leads right now. So let's just start at the top. There's a lot of potential energy to the downside that's in the stock market right now. So let's just look at some metrics that I love. I'm going to mention three. First of all, I look at the price to sales ratio. Why don't you just look at the PE ratio, Mr. Pento? Well, because if XYZ Corporation goes out and floats a bond, raises a bunch of debt to buy back its stock, it tends to lower the PE ratio because it increases its earnings per share. Logical? Yes, it's factual. That's what they've been doing at record proportions. I look at price to sales because you cannot fudge sales unless you're lying and going to jail. So revenue is much more harder to manipulate. Revenue per share. So if you look at it right now, it is 3.11 on the S&P 500. That is the highest it's ever been by a whole heck of a lot. For reference, the price to sales ratio for the S&P 500 back at the peak of 2000 was 1.77. So this gives you, that's, by the way, before the NASDAQ dropped 80% in 2 years and the S&P dropped 50%. That's how far over the skis the stock market is. Second metric, which I mention almost all the time because it's my favorite metric. We're now at if you look at the total market cap of equities to GDP, we're at 205% of the underlying economy. Again, a very difficult metric to fudge. Okay? Why in the world would the stock market ever be far divorced from the underlying economy? Well, where was it in the peak of 2000? It was 1.4%. Now, as I said, it's 205%. I'll leave you with this one final statistic about this area, is if you look at the trailing 12 months, if you look at inflows to equities, they are $1.1 trillion of net inflow into equities. And I'll say this slowly because you're not going to believe it when I say it. But that is the highest amount of money going into equities over the last 19 years combined. Should I say that again?
Well, do you mean amount per month or something? It's a record for
the rolling 12-month inflow, net inflow to stocks.
Okay.
$1.1 trillion net inflow into stocks. If you combine all of the last 19 years of the net inflows into stocks, it's greater over the last 12 months than the last 19 years combined. That's how much money has poured into the stock market. That's not my data. That's Bank of America's data. Okay? So we have, and Bloomberg published it. So we have the most overvalued and dangerous market there has ever been in the existence of mankind. And there's a whole heck of a lot of things done again that have to go right to keep it afloat. And as I've warned many times before, and there's no guarantee here, I don't just think about something that's going to happen 6-7 months from now and just say, okay, let's just go short the stock market now or just buy gold or hide out in cash. I mean, I wouldn't have had a good return this year or last year if I just did that. A very negative return, which we have not had. So you have to time the market based on the second derivative of growth and inflation. And it looks to me, my model, that around the second quarter of 2022, things are going to look very, very ugly for the market, simply because we're going into the biggest fiscal and monetary cliff since World War II. That's my view on the stock market. Now, before I send it back to you, I want to say one more thing. So we had this truncated period of deflation, disinflation, and deflation, and slowing growth in the third quarter of this year. Now, the fourth quarter this year is more mixed. We've had a lot of, the Delta variant has started to wane. We've had a lot of more reopenings of the global economy, and that has kind of stabilized that disinflation, deflation for another truncated period of time. But it's my belief that come the end of Q1, the beginning of Q2, we will be solidly in a slowing growth and disinflationary environment, which I believe is very dangerous given that construct of a very overvalued stock market, which could lead to a liquidity crisis, a stock market crisis, and an economic recession/depression. That's how dangerous we are right now.
You've talked to us about this basic outline of the scenario that you just described over the past several visits. And one of the questions from a viewer is, what are the key indicators that you are looking for as the early, sort of the leading indicators that we are actually in that scenario, that we're actually advancing down the stages of that scenario?
So I have a 20-point model. I look at things like the Baltic Dry Index, which is plunging. I look at oil prices. I look at the CRB index. I look at credit spreads. Those are the kind of things that update on a daily basis. So you have to look at very high frequency metrics to understand where the danger lies. And it was amazing, though, if you look what happened Friday, you didn't see a big blow up in high yield spreads or credit spreads. That gives me more confidence not to go net short in the portfolio. Now, to be honest with you, on the day before, so this was Tuesday, the day before Thanksgiving, which was Wednesday, my model said to get a little bit more defensive in the portfolio, and I added an ETF, which also has a volatility component to it. So it buys VIX futures. So it'll buy stocks, but also have an underlying component of going long VIX futures just in case there was a spike. And that particular component had a very good day on Wednesday, even though my overall portfolio was down, but much less than the stock market was down. So you have to look at these high frequency components to let you know when to be worried. You're looking at yield curve differences, and we are flattening on the yield curve. We are rolling over on the CRB. We're rolling over sharply on the Baltic Dry Index. And I'm not going to sit here and bore you with my 20 component model, but it's saying we are waxing more and more towards that period where you have disinflation, deflation, recession, and depression. There's a very high likelihood of a stock market meltdown come the middle of between the first and the second quarter of next year.
Related to that, and the Emperor's New Clothes asks, will the Fed continue to taper, and for how long? And will they stop at the first dip in the markets and prove they can never stop QE infinity?
Yeah, well, it's interesting that Raphael Bostic? I don't know if the guy was first name now, but he said after the crash, and by the way, what happened on that holiday shortened session was absolutely dramatic. I mean, they were dumping, I think oil prices crashed, 13% in one day. I'm trying to remember what all of these reopening trades, the airlines, cyclical stocks, they just got slaughtered on Friday. And we still had one of the Fed presidents say, you know what, we're still on track for tapering. Now, the taper is going from $120 billion a month to zero in June. The average amount of money printing over the last 18 months, Donegan, has been $250 billion every month of new money. This is an infusion of base money. And I just take a second just to make sure everybody understands. This is high-powered money. It's the monetary base which they're building. And they give banks this money and they say, hey, here's this base money. Go out and buy more stocks, buy more bonds, buy junk bonds, buy stocks. Go out and make new loans. This is the high-powered money, which is used as, again, to increase the broader monetary aggregates. So we actually had this Mr. Bostic say, even after the crash, the mini crash on Friday, that we at the Fed are still thinking of expediting the taper. And the reason why they're talking about ending it, even maybe perhaps before June, despite the fact that the stock market fell to 2.7% on the Dow, I think it was 2.75% on the Dow, is that they are scared to death of the monster they created, which is what I mentioned when I started the show, the biggest equity bubble on record. And they know there's a very good chance it's going to implode and send people to the poorhouse. And the faster they get out of QE, the better off they are. Banks are flooded with cash. They're gambling on things, like look at what happened to cryptocurrencies. I mean, cryptocurrencies are becoming a systemic risk to the entire market. You have, Bitcoin, which was $65,000 a unit not too long ago before it plunged by 20% in a matter of days. You're going to wipe out a lot of Wall Street if this cryptocurrency charade collapses, which I think it will. So they understand, because inflation's running at 6.2% year over year. They understand it's a CPI. They recognize the housing market is now more expensive today than it was, just prior to the biggest bursting of the bubble in history, which was in 2008 when it started to drop by 33% on a national basis. They understand they have to stop fueling this bubble, and they will do so unless and until the stock market plunges by about 30% or more. That's my thesis. And does anybody want to sit there and wait for their retirement savings to plunge by 30% before they hope that Jerome Powell wakes up and says what exactly? That we're not going to taper? Is that going to actually cause the stock market to regain all of its wealth, especially when inflation's already above 6%, the way they measure it? I don't think so.
Related question from Huen Rowe says, I know you've mentioned that the bubble will burst when the rates go up, but will this also be the case if the Fed raises the rates very slowly? Also, how fast of a rate hike will they need to do? So
I did some research about this. It's not going to be very shocking, my answer. So the average spread between the 2 and 10-year note is about 2.25%, or 225 basis points. That's when the Fed starts to raise interest rates. The 2-year note, the 10-year note have that 2.5% spread. The spread now is 1, just 1. And that might not seem like a lot. Well, 125 basis points, 150 basis points. Why is that such a big deal? It's such a big deal because when the Feds when they start to kill the stock market bubble, and every iteration beforehand, they always raise interest rates and kill the stock market. This particular iteration, it's at 1%, and they have to wind down this $250 billion QE before they start hiking rates. Now, they haven't really even begun the taper. I mean, let's just see. So it's $120 billion a month officially, and they're taking it down to $105 billion by the end of this month, which is still significantly greater than they were at any time ex post the great financial crisis. It was $85 billion at the apex. So by the time they get to zero around June, I anticipate the spread between the 2 and 10-year note to be almost zero. Could even be inverted. So why is that important, Michael, you ask? Well, every time, this is not most of the time, every time you have an inverted yield curve, a recession occurs in the very near future. It's just several quarters away at the most. So if they start to raise interest rates after the taper and you're already at an inversion, you're going to have a stock market meltdown like we never had before. That's my answer. I don't think they can end tapering and start to raise interest rates very, very far. It'll be less than 100 basis points, less than 4 moves before they implode the whole thing, if they can even get that far. How's that for an answer?
That's pretty concerning. Now, part of this is there's a question here related to the context of everything you just described, but bringing into the discussion the size of the debt. Bruce Barr says, how many more times will the market turn down and the Fed be able to print more money to prop it up? The balance sheet of the Fed is growing exponentially, and this is not feasible to sustain. At what point would the entire system collapse from its own weight of this debt?
Here's my thoughts on that. My visceral response is the balance sheet went from $800 billion in 2007 to $8.5 or $8.6 trillion today. I mean, that's an exponential increase, as the questionnaire so appropriately pointed out. The difference now, and people say, and I've done a lot of research on this too. And again, when I do research done again, I don't have a theory and then try to back it up. I mean, I just do the research, and wherever it leads me, it leads me. And I'm very much convinced that the next time the Fed, like I said, the next time the Fed starts to raise interest rates, the whole thing will implode. And I don't think they can get very far at all. And the reason is, most importantly, if the Fed came out, Jerome Powell said, we are now going to continue with QE ad infinitum, and we are going to pledge to keep the Fed funds rate at 0% for the next 10 years. Just come up with I'm just trying to answer the question. What would that do to the bond market? So here's the major difference. Before this crisis happens again, we always had the luxury of, as far as the Fed is concerned, of disinflation and deflation. We always had quiescence in the bond market and quiescence with the currency. In other words, hey, we'll go back into QE, we'll go lower interest rates, but what's the problem? Our major issue is with deflation, collapsing asset prices, but most importantly, trying to get the CPI, or the way they measure PCE, core inflation, back to 2%. We're already 3 times higher than their target rate. So here's the question, and here's the ultimate answer. If we have a collapse next year, asset prices plunge, and inflation is still running at 3-4%, which is way above their target range, and the Fed they come out and admit, hey, holders of our currency, holders of our sovereign bond market, holders of our sovereign debt, we will never be able to drain our balance sheet. Forget about that. We will never be able to defend our currency by raising interest rates. We will never be able to actually forget about, ending QE. We won't ever be able to drain our balance sheet and even end QE. We'll never be able to stop printing money. And what does that do to a investing world that has already lost confidence, or is losing confidence rapidly in our bond market and in our dollar against hard assets? That's the big caveat. That's the big difference. I don't think on the next, deflationary recession / depression that we have, that if the Fed goes back into QE and goes back into this pledge of perpetual 0% interest rates, that the bond market will remain quiescent. That's the big difference.
There's been a lot of talk over the past month about potential nominees, both for the Fed chair and then also for the comptroller of the currency and so on. amid a flurry of concern about position papers that have been presented by some of these new nominees, advancing that the way to get some of the more control in an uncontrolled situation, like you mentioned, is to have the Fed basically have all the accounts at the Fed and have complete ability to bail in or to prop up or take down any markets they want. So Bob Miller asks, with the Banking for All Act and views of people like Omarova and Brainerd, it seems that the goal is to have the Fed overtake the banking system and supplant all competition. Would such a move, first of all, do you think something like that is likely? And second of all, if it happens, do you think that changes the game? Does that completely redefine the game board from what you're describing in a way that might make the possibilities different for what they can achieve in control?
Well, so first comment on the renomination of Powell, and Lael Brainerd was more interested in diversity in her acceptance speech than what her real problem is fighting inflation. I just find I'm all for diversity, but I don't think the Fed's or any central bank's concentration should be mostly on that. Look at the damage they've done to the middle class and continue to do. The whole concept behind cryptocurrency, in my opinion, why would any sovereign nation allow the usurpation of their currency voluntarily? It just doesn't happen. So why are they allowing these cryptocurrencies to run wild? I think they want to get people used to a purely digital currency. And then when you replace a Bitcoin or Ethereum, Litecoin, whatever's out there, you replace it with a Fed coin. And what does that do? So that essentially, and this answers the question, that essentially wipes out the Treasury. So in normal circumstances, you have to have a Treasury, it has to get permission from the Congress to raise debt, and you have to raise the debt ceiling, which may or may not be raised this time, but sure it'll get done through reconciliation. You have to worry about the Treasury borrowing the money from the Fed gives the money Treasury, and the Treasury has permission to send it out to people through helicopter money or UBI, whatever they want to do. If you have a Fed coin, then everybody, even the non-banked individuals, everybody gets a wallet. And the central bank of the United States can just send money to that wallet without any permission from anybody. I mean, who did the Fed ask? Going back to, Bernanke, all the way to Powell. What permission did the Fed ever have to ask to go into QE or expanding its monetary base? The answer is nobody. So what they can do, once they they ban all cryptocurrencies that are private. They have a public Fed coin. There'll be a Euro coin, could be an IMF coin. I don't know. ECB coin, PBOC coin. That's what China said. Now, even the unbanked gets a digital wallet, and it's up to the Fed. Give them anything they want. Just credit your digital wallet, and it's over. You never have to worry about the Treasury going to Congress and asking to permission to raise more debt. So that's where we're headed. I hope that answers the question. You've
talked about the scenario of the Fed losing control one way or another. There's been some concern, and we talked with Alistair McLeod over the weekend about the Turkish lira running away from itself versus gold over the past month. Ben Hassan says, we are focusing on the rate of inflation here in the U.S., but what would happen if countries around the world start having really high inflation rates and start losing control over their currencies? Do you think that will have any effect here in the U.S. or the U.S. dollar in general?
Well, it'll be very beneficial to the U.S. dollar. I've been long the U.S. dollar since the first quarter of this year. I think it's up significantly for a currency. But here's a better point here. What happened with Turkey is Mr. Erdogan says to his central bank, hey, do this or you're gone. That's why they had like 19,000 central bankers in the last year. So the wall between the president of a nation and the central banker is gone. And Turkey doesn't exist. You're a puppet of the government. And that's the big danger, which I see happening not only just in Turkey, all over the world. All over the world. Used to have a Chinese wall. Well, let's just go back to 1913. Central bankers never had even the ability to engage in QE. But we gave Powell the ability under the Emergency Powers Act. He could buy junk bonds, and he did. He underwrote the entire bond market. So the power to the central banks is getting stronger and stronger, and the wall between the elected officials and the central bankers is disintegrating.
So how do you think that plays out with world currencies? Because the questioner went on to say, if people see other currencies failing, will they lose confidence in the dollar? You're saying no. You think that? Well,
I think they'll lose confidence. I don't think they are losing confidence in all fiat currencies. But when you talk about the dollar against what? So the dollar against the yuan, or the yen, or the lira, the Turkish lira. No, the dollar is not going to lose ground against them. They'll be, dollar is a funding currency. And when you have an implosion of economic growth, they close out that carry trade. So people rush into the dollar. That's what you almost always see in times of international distress, that the dollar is a major beneficiary. But the other question is, okay, the other part of that equation is the dollar gains ground against other fiat currencies, but loses ground against hard assets. The two can happen at the same time. It has happened many times in the past and will happen again in my opinion.
In this scenario you've been describing of an eventual catastrophic collapse or major pullback in the markets middle next year perhaps, or in second quarter, prior to that, you already described that the market valuation by the metrics that you're looking at internally are almost 2x what they were at the previous peak. And Sean Hendrickson says, when do you think the market will finally melt up? Do you feel it already has, or do you think there'll be something even more dramatic coming before a pullback?
I'm not sure I understand the question. So melt up, it was the biggest melt up in equities the world has ever seen. So I'm not really worried about a melt up. I'm trying to squeeze out the last few percentage points in a net long portfolio until the end of the first quarter. But I'm doing so more and more with hedges done again, to be honest with you. It's getting more and more dangerous out there just to be flying, net long a portfolio. But most of, this, at least I try and I have a very successful record. The robustness of the model proved itself again last week when it actually told me to put on a short the day before the market melted down. But you have most of Wall Street just buy and hold. They're just buy and hold 60-40 portfolio. And they're both those asset classes, stocks and bonds, are going to get wiped out. Okay, especially if you look at the corporate bond market. Maybe not so much with short-term treasuries, but the corporate bond market and equities in general, they all go to a correlation of 1. Almost everything goes to a correlation of 1. You look at even what happened with gold. I mean, if you thought what happened on Friday would be good for gold mining shares, you're completely wrong. I mean, they got hurt just as much as any other stock, pretty much. Which is very disconcerting because everything is owned in these ETFs. So everything gets piled in these ETFs. Apple is owned in 1,000 ETFs. Amazon, Google, everything gets sold. It's a liquidity crisis, and everything gets dumped at once. And that's what's going to happen again, unless you own those 4 horsemen of the economic apocalypse, which I have been on record saying. Those are the only 4 things you can ever own.
Why don't you go ahead and remind our newer viewers of those?
So U.S. dollar, cash, short-term treasuries, and short the market. If you can do those 4 things, you probably will actually make money in a liquidity crisis like that has worked every other time throughout almost every other liquidity crisis on record.
As you mentioned, even gold mining companies got hurt during the market sell-off on this last Friday. Scoobyism3 asks, would you buy oil stocks now? So oil stocks are another one where there's the perception, at least, of an underlying physical commodity that's justifying the cost of the shares.
So my model tells me to buy oil when both growth and inflation are accelerating at a faster rate, and that is not going to happen in 2022. So you're picking up, as they say, pennies in front of a steamroller when you go long oil here, in my opinion.
You talked to us before about a core position of 5% exposure to gold to help insure your portfolio against volatility of other kinds or other types of systemic risk. What kinds of factors do you look for that tell you that it's time to increase beyond that 5% core position in gold?
Well, I want to see nominal rates fall and real interest rates fall. So I will aggressively buy gold when I see the economic data start to weaken, which should happen next year, in the first quarter of next year. I think there's a lot of good data coming out now. And the predicate here is that everybody knows about these supply shortages. You know, you paid people $6 trillion in the last 2 years to stay home and do nothing. And then you wonder why, you know, there's not enough people to unload the ships when they land in the port. So I believe that goes away next year. I think people slowly return to the workforce. You unwind some of these bottlenecks, and that'll cause the rate of inflation to fall. But I also think growth is going to fall even faster because if you look at I think there's still 5.7 million people that are still out of work. So if you look at what happened prior to the outbreak of the Wuhan virus, I'll say Wuhan virus. You can edit that out if you don't like it, but that's where it came from. You ever hear of the Spanish flu? So I don't mean that as a pejorative term. COVID-19, called COVID-19. Prior to the outbreak of COVID-19, there are still 5.7 million people less in the labor force. And even if everybody suddenly got hired, you have to remember, because of that $6 trillion that was handed out by the government, these people made more money by staying home than they were if they were employed. So I don't think 5.7 million people are all going to get hired in the next couple of quarters. I don't think that's the case. So you have the biggest fiscal cliff since World War II. We're going from like 15% of GDP to 5% of GDP as far as government deficits as a percentage of GDP. So yes, I do believe that economic growth will slow very much in the first half of next year. And you should protect yourself from that.
Michael, if people want to follow your work and benefit from your insights, how can they get tapped into that?
So my website is pentoport.com, and you can email me directly at mpento@pentoport.com. And on the website, you'll find a midweek reality check, which is $49.99 a year. It's a 5-week free trial. You can get all of my commentaries and my thoughts from the 36,000-foot level. And if you have around $100,000 to invest, you can open up an account at Pentoport, and I'll take care of your money personally and put it in the inflation, deflation, and economic cycle model.
One more bonus question from some John Doe. Please ask Michael what his favorite Beatles song is. And there were already 2 comments suggested underneath that. One is The Tax Man, and the other is Money Can't Buy Me Love. Unless you had any others.
You know what? One of my favorites is it's probably not the most popular. As my guitar gently weeps is probably like the most coolest thing. Right? But I like Here Comes the Sun. And that's one of my favorites. And Hey Jude, I like the most popular ones. Sorry, I disappointed them.
No, just getting your fresh personal opinion about that is all they were looking for. So thank you very much. As always, we look for your straight up answers as you always offer them here for the way things as you see them. And just grateful for your presence on behalf of all of our viewers here on Liberty and Finance.
Thank you so much for having me on, Tom.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.